This is Philip Chow. I'm the founder and chief investment officer of Experiential Wealth. We just finished fourth quarter commentary. Happy to sort of think about what has transpired in 2022 and perhaps what may transpire in 2023. And the immediate thing that comes into mind is the future is always uncertain. It's always been, this stating the obvious. More uncertain, shall we say. And the reason why it's more uncertain about 2023 going forward is we are still struggling with inflation. We're still struggling with interest rates, the central banks around the world. What are all the central bankers doing? Geopolitical risk in Russia and Ukraine, China and US regarding Taiwan. And I would say the biggest anchor of that from a financial, from an economy standpoint, is really the interest rate. Right? The Fed decided that it's time to do something about inflation because it was running pretty quickly and pretty high. And so to do that, they raised rates. Well, raising rate makes a difference because it's supposed to temper in spending money. We all know supply and demand, right? So if the demand falls, then the prices will come down, and that's the idea. Well, the complexity of it all is because this time is a little different than just simply demand. It has both a supply angle and a demand angle to it. And interest rate does not have an immediate and direct impact on supply. Chair Powell talks about long and variable lag. What are we talking about, long and variable lag? Meaning that we are not certain the exact impact of an interest rate hike, especially 425 basis point or 4.25%. And it takes time for the impact to be felt. It's not immediately observable or felt. That's another part of the uncertainty is, okay, rates have gone up. People who are savers are very happy because they're making 4.25% or something like that on their savings, which they have not seen for a decade plus, 15 years. But from people who are trying to get a mortgage, trying to buy a car, anything that requires credit, that's going to be impacted. But how severe is the impact? How severe is it going to be impacting on the demand? It's uncertain. And what is the impact globally is also uncertain because US is the largest economy in the world, and US dollar represents 60% of all trades is done in US dollars. When interest rates go up, guess what? Everybody likes higher interest rate. In that sense, they want to buy US denominated assets. So that what happens? Then US dollar goes up. That means we are importing deflation, meaning that for every dollar, we can buy more. So that's good, right? But it's exporting inflation because everybody has to spend more to buy the dollar denominated goods and services. So there are all these global effects. So that's just talking about on a very general macro way of what interest rate is doing. But then there are also geopolitical risks, Ukraine and Russia. This could end anytime, but it could go on for years. We don't know. And it has significant ramification that we already have seen in 2022. Weather has a big impact on gas price and because of usage. 2022 has been a somewhat warmer climate year than was anticipated or expected. Next year is going to be warmer? Who knows? There's also humanitarian costs, of course. Let me not understate how devastating that is for the Ukrainian people and also certainly the Russian. Issue about China, that's about the only unified policy that we think the Congress has at the moment is everybody is down on China and worried about China going to take over Taiwan. And the threat of this one China policy, is it a facade or is it real? What is that ramification of all the additional policies that is being imposed or will be imposed on trade with China, which is the largest exporter in the world, and which goes to the bigger and larger theme of deglobalization, of fracturing of the global economy in terms of supply chain, then regionalization, which is basically saying, well, if we're not globalizing, then we only do want to work with our friends. And what is the impact of that? Easiest thing to think about is cost, meaning inflation. If the supply chain is less efficient and we're to replicate a number of supply chains for resilience or to get away from people that we don't like or we don't believe we like, then the replication or duplication of supply chains is going to cost us more money. And we're not always going to be the lowest cost provider. That will have direct impact on whom? On you and me, right? The consumers. We can't get the stuff that we used to get at the prices we get them. Energy transition from old energy to new energy, and the terrible handoff that we have, or we don't have a handoff, we just kind of abandon and not reinvest. So all of those contribute to this uncertainty. And that's sort of the theme for 2023, but it's not a new theme. It's a continuation of a 2022. But we expect more volatility in the stock market, expect perhaps more volatility in the bond market. It all depending on inflation, what the headline inflation is going to look like, what the incoming data is going to look like, which would help to direct where interest rate policy is going to be. So one of the things that we come out of all this discussion in terms of implementation, in terms of some of the things that we think about, is that I think cash is a real good thing. Having cash is really good when we can do nothing and make 4-5%. We don't have to take extraordinary risk, volatility, losing money, risk by going into stocks or even long-term bonds. That's one thing that we can safe to say, safe asset, right, which is treasuries and CDs and that type of thing, is yielding something that we have never seen before, or we have never seen before in the last 15 years. And it is a viable asset class, viable investment, and we shouldn't poo-poo it. So that's how we ended our quarterly report, by really thinking about how to asset allocate. That's not to say abandon all stocks and abandon all bonds, but cash plays an important role. And that we also suggest that the 60-40 portfolio, which everybody poo-pooed on, 60% in stocks, 40% in bonds. I think overall 60-40 lost something like 17%. I don't think that's going to repeat itself this year. And especially if you can put a little bit of cash in there, you know that you can safeguard against any losses from a market standpoint.